Hi there, everybody. This is Morris over at San Jose Options, and I wanted to talk about this newsletter that we sent out in 2013 and just briefly explain some of the concepts in here verbally so it's a little easier to understand. The important message in this email is about the accuracy of risk analysis and how important it is to be able to analyze your risk as well as your profit potential as accurately as possible. And if you're working with options, then obviously you'll never be able to analyze your risk entirely accurately, because it's just impossible with volatility, bid-ask spreads, liquidity, things like that. However, there are methods to get a closer risk analysis than you're currently using. So that's what I wanted to address in this newsletter. Okay, so first of all, the typical method that people have been using to analyze the risk with options is the Black Scholes formula. And this came out in 1973, and it's really been around pretty much since then. And it's I think the number one pricing model that's being used in most of the software, the platforms that are out there on the market. So the way that it typically works is you'll have controls in your software to change, like implied volatility. You can change your date to expiration, and most software will just include those. There's other variables that work into the formula, but the volatility and the date, as well as changing the price, those are going to be the strongest factors of the price model. Now, volatility is going to be the strongest factor in the pricing model. So, I mean, you may have be analyzing a trade with plenty of theta. Let's say you're looking at a condor, and you have some theta here, and so you use the Black Scholes, and you move the calendar forward, and you see the trade's making some money. But then you notice if you change volatility like 10 points, for example, or 10%, then all of a sudden your condor, like all of the profit you're making with your theta, it just disappears and the trade loses money. So you can see that by using the tools that's provided to you in the different platforms that are out there, that the volatility is the strongest part that can influence your profit or loss in your option spreads. Okay. Now, the important thing. Okay, sorry about that. I got a telephone call. And so, what I wanted to talk about in here is really kind of this area. So when we're working with the Black Scholes, we have these controls like the implied volatility. You have the date. You can change the price around. You can stress test your trade and estimate your potential profits, and also try to identify your risk exposure. Okay, but there's certain problems with this way of stress testing. Number one, it's kind of hard to just correlate, how many days to change the date, and then a reasonable amount to change volatility. That's one problem. Another problem is when you're dealing with different months, then they all react differently to volatility changes. So your closer term months, they'll rise and drop faster and farther out in time, then they're going to move slower. So those kind of factors are, you're just kind of basically winging it when you're trying to use the Black Scholes model to identify your risk. The other issue is that this formula it assumes that there's no issues with liquidity, that it's very simple to fill all of your trades Basically, it assumes like you could just get filled at mid every time, and there's no problem with order execution or bid-ask spreads. So all of these factors, when you start to stress test your trades in this manner, then you could be off by 1%, 2%, 10, maybe even 20% on your analysis. It's really hard to say, but the fact is that you could be off very far. And so when you're working with a regular account, okay, well, 1 or 2% may not be so much, but once you move up into working with portfolio margining, then every percent makes a huge difference, because you may be working with an account, let's say 200,000, but you might be actually managing $5 million. Okay, so once you start to work with this extra leverage, then obviously 1% or 2% is a lot of money. Imagine if you're 2% off and you're using $5 million, well, you're looking at $100,000 difference there in your stress test. So you may be stress testing a trade and think that your risk is 100,000, but if you're off a couple percent, your risk exposure might be 200,000. And so just like that, your analysis here using this Black Scholes can obviously lead to some serious problems, because again, just a few percent off and you could be off by hundreds of thousands of dollars depending on how much leverage you're using. So one thing that's cool is, in our course, in our software, we're working on addressing this issue, and we've developed some tools that can help with some of these main points here, which is like trade sizing, okay, and what I mean by this is again, it's addressing how much your portfolio is worth, how much leverage you're using, how much insurance you have on, how much of your income spread you're working with, and it helps you size your trades accordingly and give you a better risk analysis and in a truer exposure. That's why we call our software true, by the way, because we're incorporating so many parts of reality are integrated into our software. So number one there, could help you with the trade sizing. Number two is we have proprietary backtesting tools, as well as stress testing tools. Okay, so backtesting and stress testing. Okay, that'll be able to give you more accurate readings on your risk exposure as well as your profit potential. So in a lot more efficiently and faster than any other backtesters that are out on the market. So these right here can help you so much. Number three is we have some other proprietary tools based on volatility that, again, you don't find in other platforms. So I'll just call them IV indicators. And these implied volatility indicators that we have, again, can help you realize, identify your true risk exposure, your true profit potential. They can help you enter your trades at better times, exit the trades at better times, and things like that. So anyway, there's a whole collection of tools that we have in our software to address these issues. Remember, we've been working with portfolio margining for years. We've been teaching it longer than any other course on the market, trading it ourselves. We know the ins and outs, the pros and the cons, and we do realize, again, that you are given so much leverage, and again, it's so important to be able to analyze that risk exposure, and not only accurately, but extremely fast. So that's what we've done with SJ True. With our software, we're giving you the tools to help you manage that type of account. But even if you don't have portfolio margining, then you still can benefit from our software because of the again, the proprietary tools that we've integrated for you to get a better risk assessment than you can currently do using the Black Scholes formula alone. So that's about it for now. I just wanted to kind of clarify this email, let you know what it's about, and best of luck with your trading, and we'll see you in our next class.